Welcome to Momentum Monday. Today is December 26, 2022. Merry Christmas, happy holidays. Howard, have you gained any weight during the holidays?
No, the dog is losing its mind. Hang on. You start. Hey, buddy.
What did you say? Okay.
Get up. My dog's losing his mind. You go.
Okay, so let's go. So, I mean, basically, the downtrend continues. And last week, we saw more selling after Micron Technology reported earnings. They missed estimates and they guided down, gap down on Thursday. And with that gap down, basically, we saw a sell-off in tech, more specifically in semiconductors. As you can see, sold off or broke down on Thursday. A lot of the names in the sector, like NVIDIA, AMD, definitely among the weakest. So tech in general continues to be the weakest in the entire market. And in the meantime, we're seeing stocks that would benefit from higher inflation just continue to hold relatively well. Like, I'll give you a few examples, like Co-Main Foods, like they make
eggs, baby. Well, let me see a
eggs.
weekly on that. Wow.
So they're at all-time highs, I think. Yeah, all-time highs. Breaking out. Energy is starting to bounce. I mean, oil has been kind of trying to recover, building potentially a new base. Obviously, if the market is really worried about a recession.
Yeah, I mean, energy holds here if there's no recession, but
yeah, that's the big tell. If they break down, you know, we know what the market is thinking, but if they hold,
yeah, they're probably the key to like watching whether the recession is big or not.
Yeah, I agree.
Same with the banks.
Yeah, I mean, the banks, they've been one of the weaker sector. They're already back below the 250-day. So they've given back a lot of the profits that they had from the last earnings season, as it became clear that the Fed doesn't have any intention to stop raising or to pivot, at least next year. So, I mean, this is probably one of the reasons why we see strength in home builders. Like everyone is talking about a recession and a potential crisis. Go ahead, Howard.
It's a blip of life. I mean, where's the strongest was like certain healthcare and defense.
I mean, for the entire year, yes, it's been all about energy, all about healthcare. Like we have Merck, which is at all-time highs. It's been just climbing above its all major moving averages the entire year after that huge breakout it had earlier in the year.
Again, for risk reward, with the amount of stock, I think there's like 40 stocks. We're up 100% this year to 3,200 now. So it's one of the worst years ever for picking kind of the stuff that you and I had such a good run on. So I'm saying, like, for the few that have really worked, obviously besides energy, like drugs, we're talking 10, 20%. You can earn 4% doing nothing in T-bills. So it's not even worth kind of looking for these. Defense, where's the defense stocks? And now rates.
I mean, they're holding for the most part. Obviously, anything that relies on government spending is doing well as the government continues to spend. And here we have LMT holding well, kind of setting up. Boeing has been trying to recover, but obviously still in it needs time.
Bear market.
And a lot of the defense stocks are definitely holding well and have rising relative strength. Obviously, coal is another energy industry. They've been kind of going sideways for the past few months. So it will be interesting to see if they attempt to break out again. I think coal was up coal is up 10 times in the past 2 years. I mean, 2 years ago, everyone was calling coal dead.
Well, 2 years ago, they were all bankrupt. They're still tiny market caps, but there's so much leverage.
There's so much
leverage.
So a lot of interesting names that are kind of setting up again, potentially. So we'll see.
But they're not growth names. They're just dependent on leverage on the balance sheet.
What's your definition of growth, Howard? If you look at their earnings and sales growth, they are the growth stocks right now.
Yeah, but same thing. There's not endless growth. These are like,
they're just cyclical growth.
yeah, the
It's not.
cyclical growth. So I'm definitely not the expert there. And the time to play cyclical growth is before the cycle turns. So you got 2 years already since the cycle turned. Doesn't mean they can't double from here, but they're not 10 baggers. So it's a complete different type of but yeah, technically they look okay. The question is, do we roll over into this recession with yield curves inverted, with mood so bad, and with cash so low? It just seems like it's going to be, and with so much, with so many like Walking Dead kind of companies that don't have a business model left over from Web 2 and crypto, I think it's impossible not to have just a deep recession. I was going to share a few charts to kind of give pretty good technical look. Let me, can you share?
Okay, then let me stop sharing and then you can.
Yeah, and then we'll close. Again, end of year, I don't want to spend the tape is so bad.
Go ahead, Howard. I mean, the interesting thing is that this time around, treasuries are really not rallying. Like in the previous recessions, money managers and people, could hide in treasuries.
Yeah.
Right now, treasuries, they're having a worse year than the S&P 500. So all those 60-40 portfolios that are supposed to be diversified, they probably had the worst year in 40, 50 years.
Yeah. Instead of buying stocks, so I moved into bonds in June, September, October. So far, so good. I think rates continue to probably rise. The Fed's not done, but can you see my screen here?
Yeah, we're seeing it. Yeah.
So you can see this is the NASDAQ streak below 200-day moving average. So we're in the top 5 going back to the 70s. But I think what's important to know is, for 10 years, 11, 12 years almost, you just had no spikes. So I don't
bull market.
What's that?
I said bull market when you don't have those spikes. Yeah.
I mean, we're coming out of just one of the best bull markets. So at least if you're a bottom fisher, there's an argument to be made that, there's continued weakness. If you believe in tech, you can, now's historically a good time into this spike. But just based on how little the spikes were for the last 12 years, I just don't think we're anywhere close to out of the woods. So, any buys you make should have a long-term horizon. So that's the first chart. So we're definitely in some kind of nasty bear market. And then that concerns me is, and this is Krinsky and Co. at BTIG, a really good guy that I read technically. And this is really important, is that the Fed did its job. It got everybody in the market. I mean, that's not the job you expect them to do, but by the time that rates stayed so low for so long. So you have all these people that believe that if sentiment's so bad and stock prices are down so much, the recency biases. So everybody sounds bearish, but has been buying, kind of what's worked in the past. So very hard for technical readings here to be bullish. They're not seeing any kind of capitulation, meaning people are buying even though things are negative. Then the third chart that I thought I'd share this weekend, no, not that one, because we are still below. This is an old markets and turmoil chart that I like to share, because we're well below this kind of crossover. And so we're still in danger mode. There's one more chart that I was looking for. I'm going to share these two. The third one was, hang on one sec, buddy. What was this one? Is the NASDAQ, no, so unorganized. This one here from Europe, still holding a 20-year breakout. So the NASDAQ's still in a 13-year uptrend that I shared last week. And here you've got Europe still holding a 20-year breakout. So all's not lost, right?
Keep in
But
mind that Europe is a bit behind on raising interest rates, and they'll probably have to ramp it up this year, next year. So
yeah, but I'm saying we're if you want to hold a hope, you got Europe. I just think that's the last place I'd be investing. So there you go. So I'll stop sharing my screen.
okay.
So it's the same thing as what all year. One of the worst years of Momentum Mondays when you just tune into us and we give you no ideas.
I mean, there's momentum to the downside too. It just depends on your perspective. Yeah. So currently, what do we have? We have the Fed, we have the ECB, Bank of England, Bank of Japan, like all the major central banks are tightening and are probably going to continue to tighten, at least in the first half of 2023, which is just probably going to act as a headwind for stocks in general, as they're raising interest rates and shrinking their balance sheet. I think the only central bank that is not tightening is China. And probably this is the reason why a lot of the China, I'm not saying invest in China because there are political, risks there, but
no, we've been clear
probably
on
a
that.
reason why they've been outperforming in the past, let's call it a couple months. As you can see here, a lot of those names.
Yeah, but on a monthly, we're talking about still down 80-90%.
Yeah, I mean, yes, definitely. But this is just something I'm pointing out.
If the Chinese were up to their no good nick things, they already own all their own stocks. So now they could come out with like, hey, buy Chinese stocks. Like the game is nicely rigged for them. If you want to play the game, I can see why speculators, will rush back to Chinese stock because the game is the game. You don't have to love the game and the game is rigged, but right now China owns all the stock they could possibly own. So it would be in their interest to promote stocks.
All right, let's talk about gold. What's your view on gold here? Since
I think if we have to talk about gold, it's time to quit. We know the story about gold. It's a hedge. It hasn't been the best hedge for the last 6-7 years, but it hasn't been a horrible hedge now relative to Cathie Wood's. So considering it's done better than Cathie Wood's the last 7-8 years for a tenth of the volatility. I mean, this becomes the real story, though, Ivan, is it's not gold or silver because seasonally these are okay times, don't gold or silver. The real story is these false idols that this bull market is putting to rest. This is just an incredible, amount of brands, Cathie, Tiger, SoftBank. They were all involved, Altimeter, all these incredible media built in, some smart, some kind of more posers, and I would put Cathie in the poser category, other than being a good entrepreneur, not really having just being shown as pure momentum, no real trick. Live by the sword, die by the sword. But so many of these brands are being taken to the woodshedder. And the last two would be Apple and Tesla. Amazon's lost $1 trillion in market cap.
Amazon is almost back to its COVID lows. It's 81.
Again, but Jeff got out on top, right? This isn't like Elon Musk.
Smart exit,
Jeff made his mistakes and left. He went to live his personal life. Tim Cook continues to lead a very simple, quiet, growth engine. I find it quite evil at this point in time. But Elon Musk is there fighting. This is really the most interesting, probably the most interesting, fall from grace this year is, he'll always have the 30% of people that just love him and he can do no wrong. And people love their Tesla. I see more than ever on the road. He's in the best position to continue to lead this kind of revolution. But, he decided to buy Twitter. And since he decided that at the beginning of this year, April, you can see the stock's down, I don't know, 70%. So he's the 40-50 billion that he paid for Twitter has been, 6 or 7 times the amount shed in Tesla stock. So Tesla's catching up to the rest of the NASDAQ. So it's really just Apple that's left.
I mean, and Apple is also kind of looking vulnerable here.
Yeah, it looks relatively vulnerable. Here's the thing about Apple.
Yeah.
We have not seen, this is what we continue to catch up on this. The world has not seen where a company at this side controls this much. So everybody's crowded into this last bastion. If you own the S&P or you own QQQ, if Apple drops not half of what Tesla drops, so it has a 20 to 30% month to the downside. And I don't know why that would happen other than just people being redeemed and not having enough cash and just selling their ETF, which is really Apple. The real test for whether we, and this happens sometime next year, it's very unlikely that Apple is barred this whoosh down or this 30-40% correction that's befallen the other guys. They're susceptible. They're susceptible because everybody's now can pinpoint who they're mad at in the tech world. Now that Musk is outed, the only person left to bitch about, well, there's two, Microsoft and Apple. And I think in many ways, Microsoft is in a better position because it's sneaky because they are in the enterprise business. But going back to Apple, if Apple drops 20 to 30%, that means the indexes will drop, 15 to 20% as well. And the real question becomes, how do the stocks that are down 70% in China and all the broken companies, how do they perform while Apple goes through its catch up and correction, right? So that's the last thing that probably will happen of this era, which is the only way to get Apple is everybody sells ETFs. And so that's TBD, can't predict it, but I find it very unlikely that this bear market won't come for Apple. And by coming for Apple, it's coming for the averages. And we'll really start seeing relative strength in where the next bull market is once we see Apple get taken to the woodshed. I don't think it'll be Tesla. I don't think it'll be autos. It'll probably be much nichier this next bull run based around smaller companies. And it'll probably be a very interesting bull market on the other side of this, but
yeah,
until Apple breaks, and Microsoft break, I'm not sure how you get an end to this.
Yeah, you don't need to guess. Whatever shows up on the 52-week high list will be the new leaders. And currently, it's mostly defensive stocks, healthcare,
mostly defensive stuff,
and some energy. So definitely not the ones that you want to see leading.
Yeah. I don't know. If you told me at the beginning of the year Tesla would be $100 stock in December,
no one would have believed you. And
I think a lot of people would have.
The most owned stocks by individual investors, and a lot of people are like, they have their entire network in Tesla leveraged. So this is probably one of the reasons we see the downtrend continue for so long and being so steep, just because people are just getting margin called.
Yeah, no, but if you had told me that Tesla, Amazon, January 1, you say Tesla, is going to be fraud in crypto. Just pull up the S&P here. Here's the, if you tell me January 1 that crypto's going to be a zero, which it is at this point, and that rates are going to be 5% or 6% mortgages, and you tell me that Tesla's going to be down 70% and Amazon will give back all its gains. Go to January 22. So the S&P was like 4,500, 4,600.
Yeah, I mean, it's down 20%, but it's basically has given.
I would have said the S&P would be down 40%.
Yeah, it has only given back the 2021 gains. That's it. Yeah.
So I would be thrilled if you told me that I would only be down 20%, knowing what I know, from a macro perspective, from the war to the crypto to the interest rates to
it's all about energy, because energy is
but energy is just 5% of the S&P, so that wouldn't have mattered. But so really it comes down to Apple at this point. Apple's keeping the indexes different from the market, and it's looking vulnerable, right?
Yeah, definitely. I think if it loses here 130, it can go to 120, even.
Why can't it go to 80? I mean, again, it doesn't. That's what I'm saying. We don't know what will drive it down there, but then you get some chaos when people stop believing in the buy the dip, and you start taking Warren and see what Warren has to do with his cash stash. So that's kind of all that's left. If we turn up from here, we'll keep you and I, like always, keep an eye on the 52 and all-time high list. It's kind of boring. A couple of the leaders that maybe a pull back. Axon was one of the leaders, which is Taser. It's pulled back. Some of the biotechs have held.
Yeah, definitely, and some individual biotechs have held, but these are really hard to invest
these are all
with
very
size
narrow
in them.
Yeah,
because you
but
never
this is
know
what the
when.
next bull market's going to be. Is going to be these great,
very likely to be biotech.
Yeah, but well, just more smaller names that people will have to do work on.
Yeah, there was a
won't be in
huge.
the indexes. Won't be as apparent in the
Look at
index.
this MDGL, big record volume breakout last week. It just continued for a few days. And this one, its range for the past 10 years is from 5 to 400. Like, biotechs are just insane in terms of range. But also, it could be an opportunity for some if you know how to play them.
Yeah.
So,
anyways, all right, everybody have a great week. I guess we're not until the beginning of next year.
Yeah, see you next year.
We'll see everybody next year. Happy New Year. Happy New Year.
Happy New Year. Bye.